From the outside, the engine of the American economy projects absolute certainty. These illuminated facades present a picture of endless stability. But beneath the surface, a silent pressure is building. Households, major corporations, and local governments are currently carrying a record weight of unmanageable debt. The sheer volume of the trillions owed is only part of the equation. The more urgent mystery is identifying who actually holds the risk and who will be left exposed when the system fractures. Many of the 10-year borrowing cycles initiated during the last decade are projected to mature and require refinancing by 2026. Understanding this timeline is the only way to anticipate the severe economic shift ahead. For decades, the American dream was mathematically straightforward. A single stable income could reliably support a family, put food on the table, and build savings. That financial stability physically manifested in millions of suburban homes. Access to this lifestyle was once a baseline expectation for the middle class. Today, the cost of those baseline expectations has detached from the earning potential of a standard household. Housing, healthcare, and education expenses have steadily climbed out of reach. This chart maps a mathematical divergence known as the consumer gap. Average wages remain flat, while the cost of basic needs rapidly ascends. Families cannot simply budget their way to stability. To survive, they fill this void with credit cards just to pay for essentials. This erosion of purchasing power is striking. The capital required to buy daily groceries has multiplied, while wages have struggled to keep pace. Consumer debt has morphed. It is a structural requirement to maintain a basic standard of living in the modern economy. This exact pressure is mirrored in the corporate world. Businesses serve as the second major gear, operating under massive financial obligations. For years, central banks maintained historically low interest rates. This environment of cheap money heavily incentivized executives to borrow billions rather than relying on actual organic profit to fund operations. Instead of fortifying stable, long-term infrastructure, these borrowed funds were frequently directed toward rapid expansion and stock buybacks, engineered to satisfy short-term investor demands. While this influx of capital drove stock markets to historic highs, it silently built a massive ledger of underlying liabilities. Every borrowed dollar is a dollar that must eventually be repaid. The mathematics of corporate debt shift when interest rates rise. The cost of borrowing and refinancing old debt suddenly becomes expensive and chaotic. Weaker companies, entirely dependent on a continuous cycle of cheap loans, quickly find themselves unable to service their own interest payments. To survive these immediate defaults, corporations execute a predictable sequence. They freeze hiring, halt new investments, and initiate mass layoffs. This is where the corporate ledger collides directly with the household budget. A sudden loss of income means families instantly lose their ability to service their own accumulated personal debts. Historically, when abstract equity values collapse, the results manifest as physical liquidations on the sidewalk. Savings and livelihoods are consumed for immediate cash. Ordinary workers ultimately act as the shock absorbers for corporate financial failure, paying the price through lost livelihoods and liquidated savings. The implications extend far beyond domestic borders. The strength of the United States dollar is the bedrock upon which international markets and foreign governments base their own economies. The sheer volume of the American money supply weaves it into almost every global transaction. Its perceived stability dictates the terms of international commerce. This presents a severe macroeconomic risk. If the domestic consumer is tapped out and major corporations are defaulting, the actual economic foundation backing that currency comes into question. This network diagram illustrates the risk of a currency shift. If global investors lose faith in the dollar's stability, those connections will break as capital seeks safe harbor in alternative global markets. Such a migration of capital would rewrite global power dynamics, turning a domestic credit crisis into a turning point for American economic dominance. The American economy has faced severe contractions before. Through historical downturns, it has survived by forcibly adapting its systems and innovating out of the wreckage. But navigating this specific, debt-laden environment requires an individual response. Survival depends on an acute level of personal financial literacy and a clear understanding of how capital actually flows. As interest rates and debt obligations recalibrate, The ability to read these cycles will determine who is able to protect their assets. Subscribe to continue tracking the forces reshaping our financial future.